Welcome to Session 5 of I Spy Academy, Market Sectors and Cycles. This session is designed to give you something that many retail traders never develop, a clear understanding of how the structure of the market connects with the rhythm of the economy. By the time we're done, you'll not only understand how different sectors behave across economic cycles, but you'll be equipped to use this knowledge to anticipate major shifts long before the headlines catch on. Let's dig in. Let's start by mapping out our game plan. This session has 5 main objectives, and each one builds on the next. First, we'll define what market sectors are and how they're classified, giving you the language and framework to interpret market moves at the macro level. Then we'll introduce sector rotation, a core concept that explains how capital shifts between different parts of the market depending on the economic environment. This is a concept pros live by, and one that can completely change how you trade or invest. We'll also distinguish between bull and bear market cycles. And not just in theory, we'll show how investor psychology, monetary policy, and sector behavior interact at each stage of the cycle. From there, we'll analyze which sectors tend to lead or lag, depending on where we are in that cycle, and most importantly, how to rotate your portfolio accordingly. Finally, we'll apply all of this by looking at tools, indicators, and examples that help you anticipate shifts instead of reacting to them. All right, now let's build the foundation. What is a market sector? At its core, a market sector is just a way of grouping companies that operate in the same part of the economy. These are businesses that share economic drivers, offer similar goods or services, and typically respond in similar ways to shifts in the market. An easy analogy? Think of sectors as neighborhoods in a city. Each one has its own culture, its own energy, and reacts differently to outside changes. When something affects the whole city, like a storm or festival, every neighborhood responds differently based on its makeup. Sectors work the same way in the market. For example, rising interest rates might hit tech stocks hard, but financials may benefit. That difference matters, especially when you're building a portfolio or planning trades. Now, why is sector awareness so powerful? First, it allows you to diversify in a smarter way, not just across stocks, but across economic exposure. Second, it helps you spot macro trends early, like the energy run during oil shocks or tech booms fueled by low rates. Third, you can benchmark more effectively. Comparing sectors to major indexes like SPY or QQQ gives you perspective on what's leading or lagging. And finally, understanding sectors helps you align with where the economy is headed, not just where it's been. Here's a quick overview of the 11 major sectors, their representative ETFs, and example companies. Now that we've defined market sectors, let's get into one of the most important dynamics in the market: sector rotation. Sector rotation is the process of capital flowing in and out of different sectors based on the changing economic landscape. It's not random, it's strategic. And when you understand how it works, it can completely reshape the way you trade or invest. Here's the key idea. Different sectors outperform at different phases of the business cycle. Smart money, think hedge funds, pension funds, and institutional managers, moves capital ahead of time based on macro forecasts, earnings trends, and policy shifts. Let's use a seasonal analogy. In spring, the economy is recovering. Growth sectors like tech and consumer discretionary tend to lead. It's the planting season, risk is back on, whereas in summer, we're in full expansion. Industrials and financials thrive as capital spending increases and rates begin to rise. Then fall brings a slowdown. Institutions begin rotating into energy and materials. They're harvesting gains and looking for inflation hedges. Lastly, in winter, when recession hits, capital moves into survival mode, consumer staples, healthcare, and utilities become the defensive core. That early rotation is how institutions stay ahead of retail traders, not because they have a crystal ball, but because they read the signs and act before confirmation. So why does sector rotation happen? Because capital is never static. It flows based on changes in interest rates, inflation trends, earnings cycles, government policy changes, consumer confidence, and shifts in risk appetite. Each of those variables impacts different sectors in different ways. For example, if the Fed starts hiking rates, high growth sectors like tech, which rely on cheap borrowing, tend to underperform. Meanwhile, financials often benefit from rising rates because their profit margins expand. That shift, that's rotation. And recognizing it early is one of the sharpest tools you can develop. Next, let's break down market cycles and how they affect the bigger picture. Let's start with the bull market. A bull market is typically defined as a sustained move of 20% or more from recent lows. But it's not just a number, it's a change in sentiment, it's confidence, capital inflows, expanding earnings, and often loose monetary policy. In bull markets, investors are optimistic. Risk is in favor. You'll see rising GDP, low unemployment, accommodative Fed policy like low interest rates and quantitative easing, expanding valuations as investors are willing to pay more for growth, and leadership from growth-oriented sectors like tech, small caps, and consumer discretionary. The quote here is key. Bull markets don't die of old age, they die of excess. They tend to end not because they've lasted too long, but because valuations get stretched, liquidity dries up, or inflation starts creeping in. Now let's look at the flip side, the bear market. A bear market is a drop of 20% or more from recent highs. But again, that stat only tells part of the story. Bear markets are emotional. They're about fear, broken trust, and economic contraction. In bear markets, sentiment flips to pessimism and risk aversion. GDP contracts, layoffs rise, and consumer spending slows. The Fed may start tightening at first, but often pivots to easing later on. Investors flee to defensive sectors, dividend payers, and safe havens. Additionally, volatility spikes. The VIX becomes your North Star, and valuations compress as fear outweighs fundamentals. Here's the quote to anchor this mindset shift. When bear markets are when assets return to their rightful owners. This means the people who chase get shaken out. Meanwhile, disciplined, patient investors start building positions for the next cycle. So, how do bull and bear markets affect individual sectors? This is where theory meets application, because not all sectors behave the same way in every phase. Let's walk through some examples. Technology, or XLK, often leads in a bull market. It's high growth, innovation driven, and benefits from cheap capital. But it also tends to get hit hardest early in a bear market when rates rise or liquidity tightens. Financials, or XLF, perform well mid-cycle, especially when interest rates are rising in a healthy economy. In a bear market, though, their performance depends on the broader credit environment and consumer confidence. Energy, or XLE, tends to shine late in a bull market, especially during inflationary periods. In a bear market, it can hold up if inflation persists, but it remains volatile. Healthcare, XLV, and consumer staples, XLP, are classic defensive sectors. They may lag in early bull phases, but become go-to shelters during recessions or downturns. Utilities ETF XLU, another defensive sector, usually lags during bull runs but outperforms in bear markets due to stable cash flows and consistent demand. Consumer discretionary or XLY, big in early bull markets as consumer confidence returns, but tends to weaken sharply when recession fears grow. The tactical takeaway here is this: when you notice signs of market exhaustion or a coming shift, rotate your exposure. Start moving into sectors that historically outperform in the next phase of the cycle, not the one that's ending. Now let's go deeper. Not all sectors behave the same way in response to economic change. Some move in rhythm with the economy. Others move despite it. These are the two key categories we need to understand: cyclical versus defensive sectors. Let's start with cyclical sectors. Cyclicals are the sectors most sensitive to the business cycle. Their performance rises and falls with the economy. When times are good, they boom. When the economy contracts, they're usually the first to feel it. Think of them as the high volatility performers. Lots of upside when expansion is underway, but also vulnerable in downturns. Here are some classic cyclical sectors. Consumer discretionary XLY includes companies like Amazon and Nike. These rely on people having extra spending money. While technology XLK, like Apple or Nvidia, tech thrives when innovation is funded and capital is cheap. Industrials XLI encompass tickers like Caterpillar or FedEx. These rise when there's demand for machinery, transport, and infrastructure. Financials XLF covers the banks like JP Morgan or Goldman Sachs. They benefit when the economy is strong and borrowing picks up. Then we have materials XLB, like Freeport-McMoRan or DuPont. Materials are in high demand when production and construction ramp up. So how do cyclicals behave in the real world? Let's go back to early 2020. After the COVID crash, we entered a recovery period fueled by zero interest rates and massive stimulus. From April 2020 to December 2021, tech stocks led a historic rally. That was a classic cyclical bull run. Money flooded into high growth names because the economic backdrop favored risk taking. Cyclicals thrive when consumer confidence is high, job growth is strong, GDP is rising, and borrowing is cheap. But the reverse is also true. When those conditions weaken, like we saw in 2022, cyclicals tend to underperform quickly. So for traders and investors, this means one thing: timing matters. You want to lean into cyclicals when the cycle is accelerating, not when it's peaking or starting to roll over. Now let's flip the lens and look at defensive sectors. Defensive sectors are your portfolio's stabilizers. These are industries that provide goods and services people need, regardless of the economy. In other words, demand stays consistent, even in a downturn. The key traits of defensive sectors: low volatility, steady dividends, and predictable revenue streams. Here are a few of the most important defensive sectors. Consumer staples XLP, think Walmart or Coca-Cola. People still need to buy food, toothpaste, and household goods, even during a recession. Healthcare XLV, names like Pfizer or United Health. Demand for healthcare remains stable and is often subsidized by insurance or government spending. Utilities XLU, companies like Duke Energy or Nextera, these provide electricity, gas, and water, basic services that don't slow down just because GDP does. Telecom, sometimes considered semi-defensive, especially when people cut back on other expenses but still pay for phone or internet services. These sectors tend to shine when fear enters the market. When volatility spikes, institutions often shift into defensives to protect capital while still generating returns through dividends or stable earnings. Let's say we're heading into a recession, growth is slowing, and investors are looking for safety. What happens? You'll often see staples outperforming discretionary, utilities gaining strength, and healthcare becoming a capital preservation play. Strategically, this is where you rotate into safety. Instead of fleeing to cash too early, skilled investors position into sectors with lower drawdowns and stronger resilience. Here's a tactical breakdown. In early recovery phases, capital tends to rotate into cyclical sectors like consumer discretionary, technology, and industrials, represented by ETFs such as XLY, XLK, and XLI. As the economy moves into full expansion, financials, tech, and industrials continue to lead, benefiting from strong earnings and rising demand. During the late cycle, investors often shift into sectors like energy and materials, which historically perform well when inflation rises and growth begins to plateau. And when recession hits, the focus moves toward defensive sectors like consumer staples, healthcare, and utilities, tracked by XLP, XLV, and XLU, as these offer stability and consistent demand in uncertain times. If you understand where we are in the economic cycle, this gives you a blueprint for sector allocation, both offensively and defensively. Let's start at the beginning of the cycle, recovery, also called early expansion. This is the phase right after a downturn or recession. The worst is over, but confidence is still fragile. We start to see signs of life. GDP growth turns positive, unemployment begins to fall, and inflation is usually low or even negative. Investor sentiment during this time, cautious optimism. People aren't all in yet, but they're starting to hunt for bargains. Risk tolerance slowly begins to return. From a policy perspective, the Fed is typically very accommodative. Interest rates are near zero. Quantitative easing and stimulus programs are still active. The goal is to spark recovery and restore momentum. So, which sectors tend to lead in this environment? Technology XLK, because innovation thrives when borrowing is cheap. Consumer discretionary XLY, people start spending on non-essentials again. IWM, typically the riskiest plays, and they get bought up quickly as risk appetite returns. This is a cyclical sweet spot. The market is rebounding, and the sectors that were hit hardest, especially high growth names, tend to bounce back the fastest. A perfect example of this phase was post-COVID, right after the March 2020 bottom. Tech stocks exploded, small caps doubled in a year. Consumer discretionary went vertical. That was the power of recovery phase rotation in action. If you're positioning during this phase, you want to be pro-growth and take calculated risks, not blindly, but with an eye on where capital is starting to flow. Next, we move into the mid-cycle expansion. This is the longest phase of the cycle. The economic engine is running smoothly. GDP is growing steadily, unemployment is low, and corporate earnings are strong. But there's a shift happening beneath the surface. Inflation is starting to creep up. The Fed begins hinting at tightening, maybe pulling back on QE or talking about rate hikes. Investor sentiment is fully risk on. There's FOMO, margin use increases, everyone wants in. So how does sector leadership change? You'll typically see a rotation out of early growth leaders like tech and into industrials XLI, which benefits from capital spending and infrastructure growth. Financials XLF. As interest rates rise, net interest margins improve. Materials XLB is driven by input demand from construction and manufacturing. And energy XLE sees prices rise as commodity demand returns. Stocks still trend higher overall, but leadership becomes more rotational. The market rewards value and earnings strength over pure growth potential. This is a great time to trim extended growth names and rotate into more economically sensitive sectors that benefit from the continued expansion. A strategy tip here. Start identifying reopening plays or value stocks that haven't moved yet but are showing relative strength. This is where smart money starts repositioning. Eventually, the expansion matures and we enter the late cycle. At this point, GDP growth begins to slow. Inflation is no longer just creeping, it's now a major concern. Companies are still beating earnings, but the rate of growth is slowing. Labor markets are tight, and wage inflation is on the rise. Investor sentiment gets uneasy. There's still optimism, but more hedging is taking place. You'll see institutions start shifting exposure defensively, not because the crash is here, but because they want to protect recent gains. The Fed becomes more aggressive. Rate hikes are no longer just talk, they're happening. The yield curve flattens, liquidity starts drying up. During this phase, sector leadership shifts again. Energy XLE and materials XLB often perform well. They benefit from high inflation and global demand. Real estate XLRE can hold up if rents rise, but it's mixed depending on interest rate pressure. Defensive names begin rotating and staples, healthcare, and utilities start showing strength. This is when you want to begin playing defense with intention. You're not panicking, you're preparing. Look for sectors that still have strength, but are also less exposed to macro shocks. A real world example, early 2022. Tech and growth names started stalling. Meanwhile, energy and commodity stocks were surging. That was late cycle rotation in real time. And finally, we hit contraction or recession. This is the most difficult part of the cycle, economically, emotionally, and strategically. GDP contracts, corporate earnings fall, layoffs increase, consumer spending drops, inflation may persist or collapse, depending on how the Fed reacts. Investor mindset, fear, flight to safety, capital preservation becomes the priority. The Fed, sensing recession, begins to reverse course. Rate cuts return, QE might restart, stimulus packages are discussed, but the damage is already underway and risk assets are getting hit. So, where does capital go? Consumer staples XLP. People still need food, hygiene, and basic goods. Healthcare XLV. Medical spending is stable and sometimes even subsidized. Utilities XLU. These operate like bond proxies with steady cash flows and dividends. Gold often rises as a hedge against volatility or monetary policy chaos. You'll also see that treasuries rally, VIX spikes, and high beta sectors get crushed. This is where you need to rotate into safety, not after the damage, but as soon as the warning signs appear. Yield curve inversion, PMI dropping below 50. Earnings revisions, these are your early indicators. A quick case study in Q3 to Q4 of 2022, tech stocks sold off aggressively while utilities outperformed. That's sector rotation into recession playing out. Your goal during this stage is not to guess the bottom. It's to protect capital, stay nimble, and prepare for the next cycle. Now, let's take a look at a few different tools. First up, the relative rotation graph, or RRG. If you're new to this, think of it as a visual cheat code for sector rotation. A relative rotation graph serves to plot two dimensions, one being on the x-axis where you have relative strength. This shows how a sector is performing versus a benchmark like the S&P 500, and the other on the y-axis where you have momentum. This displays how that strength is accelerating or decelerating over time. Put together, you get four quadrants: leading, strong relative strength, and positive momentum. These are your outperformers. Weakening, still strong, but momentum is fading. Often a warning sign of possible rotation out. lagging, low strength, and negative momentum. These are sectors you typically avoid. Improving, low strength, but momentum is rising. These might be setting up for a breakout. So why does this matter? Because it gives you a snapshot of where money is going and where it's leaving. You can use it to validate trades, spot early rotation, or identify when to trim exposure before strength fades. If you're building sector positions, this tool is a powerful way to spot inflection points early, before they show up in price action alone. Next, ETF fund flows. This metric tells you how much money is actually flowing into or out of sector-specific ETFs. Think of it like tracking the footprints of big money. These flows are typically updated daily or weekly, and they reflect positioning by institutions, hedge funds, and asset managers. When you see major inflows into an ETF like XLF or XLK, it means someone is loading up and they're not doing it for fun. Here's how to interpret flows. Large inflows equal to buying demand. It could signal early rotation into that sector. Large outflows equal to distribution. It could indicate sector weakness or early rotation out. For example, if XLF sees a $1.2 billion inflow in 1 week, that's not retail. That's institutional money setting up for a move. Maybe they're expecting higher rates or stronger bank earnings. Use this data as a confirmation layer. When fund flows align with relative strength and macro context, your trade setup becomes significantly stronger. Of course, we can't talk about tracking sector strength without the basics. Price action and trend analysis. Even with all the macro and flow data, price is still king. Sector-specific ETFs like XLK, XLE, or XLU give us a clean way to analyze strength, structure, and reversals using technical indicators. Here are the core tools to use. Moving averages. Look at the 50-day and 200-day to confirm trend direction. A break above the 200-day on strong volume is a powerful signal. MACD helps identify momentum shifts. Bullish crossovers can signal the start of new rotation. RSI helps you see if a sector is overbought or oversold. Volume confirms conviction behind the move. If XLK bounces off the 50-day moving average with strong volume and the MACD crosses upward, that's a high probability rotation into tech, especially if ETF flows and macro alignment support the move. Never use these indicators in isolation. Look for convergence. Next, let's talk about breadth. This is one of the most underutilized metrics when analyzing sector health. Breadth refers to how many individual stocks within a sector are participating in a move. If XLK is rising, but only Apple and Microsoft are pulling it higher while the rest are lagging, that's a red flag. Some of the key tools to assess breadth are the advanced decline line, percentage of stocks above the 50-day or 200-day moving average, and the bullish percent index or BPI for that sector. So how do you use this? Let's say XLK is making new highs, but only 20% of its components are above the 50-day moving average. That's weak internal structure. It suggests the move may not be sustainable. Healthy trends are broad, not narrow. If many stocks are confirming the trend, it's more likely to hold. This is especially important when trying to validate a breakout, or when you're suspicious that a rally might be driven by a few large cap names. Another tool in your rotation toolkit is macro signal alignment. In other words, reading the economic tea leaves. Certain macro conditions favor certain sectors, and if you learn to recognize the relationships, you can often position before the technicals confirm. Let's go through a few key examples. Rising interest rates, bullish for financials, bearish for tech and growth. High inflation, bullish for energy and materials. Watch for commodities to strengthen. The falling dollar helps commodities and multinational exporters. Lastly, a yield curve inversion often signals a recession, bullish for defensive sectors like utilities and staples. Macro signals give context. They help you move from reaction to anticipation. You're not just trading price, you're positioning around a narrative that's still forming. And finally, sentiment and news. While price and flow tell you what's happening, news often tells you why. Earnings beats, policy shifts, analyst upgrades, and geopolitical events can all spark sharp rotation. The key is to interpret the news through the lens of price and flows. For example, healthcare stocks may surge after a new FDA approval. Energy names might spike following an OPEC announcement. A wave of downgrades in tech can accelerate an already weakening trend. You can track sentiment through news trading platforms and social media, as well as earnings calendars and analyst revisions. Remember, news is the spark, price is the confirmation. Don't act on headlines alone. But when sentiment, macro, price, and flow all align, that's your window. So we've walked through a full arsenal of tools, from relative rotation graphs and ETF flows to macro alignment and breadth. Now let's put it all together. One of the most important things to understand is that no single tool is perfect on its own. Rotation, like most market behavior, is complex, but when multiple signals align, your probability of success skyrockets. Here's what a strong rotation setup might look like. Relative strength is rising. The sector is outperforming the market. ETF inflows are increasing. Institutional money is stepping in. Price action is strong. The ETF is breaking above a key moving average with conviction. Maxi D is crossing up. Momentum is building. Macro backdrop supports it. Maybe rates are rising, favoring financials, or inflation is pushing up energy. Breadth is wide. Multiple stocks in the sector are confirming the move. When three or more of these elements align, you're no longer guessing. You're identifying a high probability opportunity. That's the edge, stacking multiple independent forms of confirmation so your entry isn't based on emotion or hype, but on real quantifiable strength. This is how institutions think. And now you can build that same foundation for yourself. All right, let's take a step back from technicals and tools for a moment and talk about something deeper, your mindset. In trading and investing, the biggest cost isn't usually a losing trade, it's a late one. By the time a sector is making headlines, by the time it feels safe to buy, it's often already overextended. The institutions have already rotated out. Retail is left chasing shadows. This is where many lose. They wait for confirmation that feels good instead of positioning based on logic and preparation. Here's the difference. Chasing is emotional, it's reactive. Anticipating is strategic, it's proactive. Anticipation means watching for signs that precede breakouts. Fund flows, rising breadth, expanding MACD, curling up before price moves, a macro tailwind forming before the chart looks obvious. This requires something uncomfortable, being early. Early means you might be in a position before it's validated. It means buying before the momentum shows up. But it also means buying value, not hype. It means you get in before the backtest looks pretty or social media is buzzing. Institutions scale in quietly. They accumulate during the fog, and when the rally finally goes public, they're already in profit. So shift your mindset. Instead of asking, what's going up right now, start asking, what's setting up to lead next? That's where the edge is. Every week, your goal isn't just to react to what happened. It's to spot the next shift in sentiment, leadership, macro data, or capital flows. Sectors don't move randomly. There's logic to the rotation if you're looking in the right places. That's the foundation behind the books we're reading this week. They're not about the market directly, but about strategy, resilience, and preparation. The Art of War by Sun Tzu teaches the power of preparation, positioning, and winning before the battle begins. Anti-Fragile by Nassim Taleb reminds us that the market doesn't reward safety. It rewards those who thrive in disorder. The Obstacle is the Way by Ryan Holiday shows how adversity and underperformance can become our signal, not our obstacle. Each of these authors captures a truth we apply in trading, that anticipation beats reaction, that discomfort signals opportunity, that your edge lives not in catching up, but in preparing ahead. Your assignments this week will help you apply everything we've covered in a hands-on way. First, complete the sector rotation case study. Choose any 6-month period from the past 5 years. Track the performance of at least 4 SPDR sector ETFs during that time. Identify what stage of the business cycle the market was in, which sectors led or lagged, and what macro events likely drove those rotations. Second, focused reading from this week's list. Look for concepts like nonlinearity, optionality, and thriving under volatility. Ask yourself how these ideas apply to sector rotation and to your approach as a trader. Once you've built that understanding, you'll put together your reflection prompt. How can I better prepare for rotation before it happens, mentally, strategically, or emotionally? You can share it in our assignment submission thread. We'll open our next session by hearing a few takeaways. In our next session, we'll shift gears and start digging into fundamental analysis. Specifically, corporate finance essentials. We'll look at how companies actually make financial decisions, capital structure, profitability ratios, and how to spot financial red flags before they show up in price. It's a session built to help you decode earnings reports, understand debt, and think like a CFO, not just a chart reader. If you've got any questions from today's session, use the QR code on the screen to submit them. And don't forget to like, comment, and subscribe. The links to our Discord and other resources are all in the video description. Thanks for being here, and I'll see you in the next one.